Good morning, Jags. This is Fahad. Today is Tuesday, August 25th. Let's get started. NASDAQ. Let's start off with NASDAQ. Up until about an hour ago, NASDAQ was firmly in green in pre-market. And within the last hour or so, it started to slip a little bit, and it lost about 50 to 60 points, in the last couple of hours. And with that, you will see Apple, which was also in the overnight session, was slightly guided higher, but it started to move down by a couple dollars. And then Tesla started to show similar kind of weakness. It's going to gap down by about $40 or 2% in pre-market. On the other hand, if you look at the pre-market price action in Russell 2000, that's not breaking at all. Russell 2000 continued to hold the pre-market gains, and it's going to be the best index to open about 0.9% higher on the session, and it's above yesterday's high. Why am I telling you all this? I'm telling you all this because it seems to me, of judging from what the futures are doing in pre-market, that we're going to have a second consecutive day of potential rotation out of growth stocks, which are mostly tech stocks, into value names. There was a lot of really nice green shoots in value stocks yesterday. And I took a page from that yesterday, and then I did a podcast on travel and leisure group because there's a lot of really good values in that sector. And you saw my podcast on that. Russell 2000 index is starting to break out from a bull flag. If it starts to clear 1600 resistance, then we're going to have an air pocket in Russell 2000 all the way to 1656. So there's still more room to come. On other hands, NASDAQ is potentially starting to show signs of fatigue, or just being tired, or just exhausted from all the buying. Tesla and Apple, particularly with their stock split news, has caused new froth and euphoria. So maybe this one just takes a break for a little while and pauses while the value stocks basically catch up. So that's the big high level view. Now, staying on this topic, I want to discuss two defense names which are our favorite. These do not need introduction, but I'm going to give you a real quick, just technical update. The first one is Northrop Grumman. Again, I've discussed this on so many different occasions, but yesterday was a beautiful power candle with a very nice breakout from the bull flag. This is attacking a major VOP resistance right around $345 to $350 per share. If it's able to take this out, then Northrop Grumman has room to run all the way to about 365. So I'm looking for about $15 to $20 move to the upside. I'm going to show you the chart. We're going to play around with this over here in stock charts because this just happens to be a bit more cleaner. Okay. So if you look at this chart, you will see what I'm talking about. This is a nice bull flag right over here. Draw the lines. You can see the VOP, and you can see right here is the resistance line. It is attacking that resistance line. So once it clears, this is Northrop Grumman. Once it starts to clear on volume 345, you can see there's all this air pocket. So my first target on this is going to be about $365 per share. So move from here to here. That's the move I would like to capture, especially if money will continue to rotate out of growth names into industrial transportation names, and defense sector is one of my favorite. Very, very nice bullish engulfing candle. Now, with that said, if you actually look at the option activity, out of money call options in Northrop Grumman, in my opinion, short-term weekly call options are rather very cheap. If you notice, the stock is actually currently trading at about 300 and stock is currently trading about $344, $345 per share. But then you take a look at these out of money short-term weekly call options. Next week, September 4th, 350 strike has a bid and ask of 210 to 390. And then similarly, if you go to September 11, weekly 350 strike calls, that's a bid of 295 to 4. Implied volatility has settled in because there's no catalyst in play. Earnings are out of the way, and these calls are rather less than 1% of the underlying. you will only need basically a 2% or 2.5% move in stock in the next course of next 2 to 3 weeks, and these calls will easily double. And that's the kind of setups we continue to spot in the market all the time, particularly in the last couple of days, where it becomes very easy to play some of these breakouts. Going to Lockheed Martin, same exact kind of technical picture. This is now starting to attack the $400 resistance, and it wants to clear this major VOP congestion level, all between $380 and $395 per share. If it is able to do that, this will also open up air pocket to the upside. So similarly, now let's draw the lines on Lockheed Martin chart. You will see, if you look at the short term, you will see how this stock finished very strongly yesterday. And if I draw the this VOP lines, it's right here at the 395 strike. If it is able to clear that, Lockheed Martin goes all the way to $415 per share. So you can see those, how I come up with those targets. This is a nice cup, very short term, cup and handle formation, and a breakout from the bull flag from 395 to 415. And similarly to Northrop Grumman, if you now go to the option market, you will see how these auto money short-term calls are stacked up. The stock closed at 395 yesterday. It is going to slightly gap higher by only a couple percent, by less than 1%. But take a look at the September 4th, next week's 400 strike call options. They have a bid and ask of $1.50 to $2.75. And September 11 weekly calls have a bid of 370. Once again, these calls will cost less than 1% of the underlying to simply play for a technical breakout. And who knows, similar to Northrop Grumman, if the rotation continues, this thing will take you all the way, maybe potentially with a power candle, all the way to about $415 per share. And so this is how I spot and basically add alerts on my screen to play the technical breakouts on very, very short term. And given the rotation we're seeing from growth to value, these are the names that I have on my watch list for today and for the rest of the week. That's it from me, Jay.
Morning, Fahad. Today I want to give an update on the golf industry. At the end of June, I provided a homepage write-up on the industry, specifically looking at Callaway Golf, which is ELY, Acushnet Holdings, which is GOLF, even Garmin, GRMN. So, when we wrote the write-up, when we wrote the homepage article, we were seeing strong demand. Basically because of COVID, because of, people being able to get outside finally. And you then transfer to the Q2 earnings calls from both of these companies and how you heard from them talking about how July wholesale demand had accelerated versus June. And it was also implied that the July retail data was also accelerating. And based on some channel checks that came out yesterday, that July data looks to be even better than expected. More specifically, Golf Data Tech, they were out with their July on-off course reports detailing retail data from major golf retailers across the United States. And if I can just show you this quick statistic, basically after a solid improvement in June, which was up 16.1%, hard good retail dollars inflected to plus 59.9% in July. And this was led by strength in irons, wedges, and woods. And those were up 93.3%, 74.2%, and 67.7% respectively. And if you look at the, compared to the June numbers, you're seeing huge month-over-month increases. So KeyBank was also out saying, looking ahead, we continue to view the golf industry as one that is favorably positioned among the outdoor renaissance theme. buoyed by both the dedicated core consumer as well as new entrants into the sport. They comment that the National Golf Foundation said that junior golfers were up recently 20%. As well as to that end, the National Golf Foundation estimates that strong rounds played trends in June, which was up 13.9%, accelerated into July. And you also saw evidence that the sport was accelerating globally. July UK rounds were up an estimated 40%. So again, when we wrote the write-up in June, we saw strong demand. We're continuing to see strong numbers. And the last thing I would point out with ELY, Callaway Golf, is you have to keep in mind of the TopGolf IPO that last I checked, if I'm reading this correctly from the Dallas Morning News, Topgolf was in talks to go public through a merger with a blank check company, Churchill Capital. So we'll be also keeping an eye out on any news there, as Callaway Golf does have a stake in that company.
Yeah, and that was going to be my question into this, because I wonder if these channel checks, first of all, are very strong. Sequential monthly improvement that we are seeing is incredibly strong. And I think we have to sort of, from a high level view, I think it's reasonable to assume that there was a bit of a pent up demand from having sports gone away for so long. I just know in my own family, there's a lot of friends and family that golf in the summertime all the time. Sometimes I join them when I find time over the weekend. Sometimes I can. But there was a rush when everything started to gradually, when Whitmer started to, in the state of Michigan, started to relax the rules. Everybody, because you couldn't go to concerts or other places where you could pack, but golf is not a trouble spot. So everybody wanted to go and book their tee times and have a great time on the golf course repeatedly, day after day or whenever they could. And so I think that this has definitely improved the sequential improvement, and that's great for ELY. But the driver of the stock rather right now, in my view, is potentially still TopGolf valuation, because I've always been of this view that TopGolf should be valued at a very high multiple, given its fast growth and very trendy, and millennials love that space. I actually wanted to do my birthday on August 14 at the TopGolf location in Troy, Michigan, but just could not find time. Anyways, so I think that's the actual catalyst for, in terms of taking the stock to much higher. But I do expect these checks to continue to be strong for more months to come. A very impressive chart and very good update on this name. Garmin has also been our favorite for some time. This chart has also been a very strong leader in the space, and looks like this thing wants to attack the new 52-week high and go to the moon. Good stuff. Chronicle.
Morning. Taking a look at BHP and UPS this morning. I'll start with BHP. Honestly, this was a bad call. When this idea went out, I think the entry was $45 with a stop at 60. Position's currently down, I think about 20-25%. Going forward, the question is now whether we were too early, or which I'm often guilty of, or if we've simply been wrong. That's the important question now. So let's start with why this went against us. Two major reasons. The first one is to do with bailouts by the Chinese government. So one thing we need to understand about China is that they are roughly 60% of the world's steel output. And if we're talking about previous business cycles, what tends to counterintuitively happen from my observation is that the weaker the Chinese economy gets, the more the country tends to ramp up steel production to pad their official numbers and keep people employed. And they would typically use that steel in unprofitable residential projects. But our thesis going into this trade was that because of the oversupply in housing and too many people's investments being tied to real estate, the government could not risk unrest by building more empty houses. However, what we underestimated was the ramp in infrastructure projects to make up for that. Ever since the pandemic, announced infrastructure budgets in China have totaled 4.8 trillion US dollars versus 4.1 for all of 2019. So even though our thinking was that they weren't going to bring out the bazooka for real estate, they brought it out for other forms of infrastructure. And if we look at recent Australian exports to China, it does check out. Like we can see China sharply accelerated its purchases from Australia, even though the global economy was slowing down. Now, we can make the argument that China might just be jawboning, because if we were to look at the government infrastructure project announcements that have come out since March, the wording from the mouthpieces has been very vague. Like a lot of these articles would only be a couple paragraphs long, and it would say they're planning to build infrastructure in this or that city without any further detail, like no names, no numbers, nothing. And when I ask my contacts from various cities about any major projects going on, they're not seeing anything apart from a couple airports being built, nowhere near what it was like in 2016. So who knows if China's government is being honest. But this does not change the fact that Australia's exports to China have gone up nicely, and for BHP, that's all that matters. But looking ahead, now that the economic situation in China has significantly improved compared to March, we have to ask ourselves whether we're going to continue seeing these Chinese government infrastructure announcements continue at the same pace, because again, counterintuitively, China's government tends to ease off its focus on steel production when things start to turn better. So I think that pillar of support for iron ore demand is going to gradually soften. That was the first major reason the trade has gone against us. The second major reason is Brazil. First off, we had the Vale Dam disaster, which took the world's largest producer of iron ore offline. And this was what lit a rocket under iron ore prices last year, which made it an easy short when Brazilian supply started gradually coming back online towards the back half of 2019. However, as we can see in this chart, iron ore prices spiked again this year because Brazil was handling the COVID-19 situation very badly, and they've shut their mines. That said, Brazilian new cases are starting to flatline, and the latest news is that supply from Brazil has picked up in early August, and currently it's on pace to almost triple what was exported in July. And if we look at the chart of BHP, it's no coincidence that the stock has started to struggle a bit following Brazil's supply recovery. And I think this is going to exacerbate as Brazil starts to ramp its production to make up for all the problems over the last 18 months. China's steel industry will not be able to run efficiently if iron ore prices stay elevated at $120 per ton. And they are wanting to buy more of it from Brazil, given the geopolitical tensions they're having with Australia. The last thing is that peak season for iron ore is around late August and September. After that, it tends to tail off, and it's even slower when China gets into winter season. So putting everything together, it's hard to see much more upside in BHP stock, because number one, we have China recovering from the pandemic, which means we're going to see less infrastructure stimulus bailouts. Number two, we have Brazilian supply coming back online. Number three, we're currently at peak seasonality. And lastly, number four, BHP, along with their competitors Anglo and Glencore, they've all aggressively slashed their dividends following their latest earnings, even though their stock prices have gone up. And dividends are a major reason why people invest in these companies. So what are we going to do with this position? My thinking now is to keep the original stop at 60 while looking to get out with as small a loss as possible.
That's what I was going to say. I don't think you're advocating adding to the short position over here, and I rarely ever do that actually. But I think you're really advocating that to keep hard stops in play at the new 52-week high, and rather look for any weakness to basically cut it out and move to the sidelines. That was my sense from this discussion. Okay, no problem. And it has indeed surprised me the surge in the iron ore prices in the last couple months, all the way back to new 52-week high. That's just crazy, given the economic conditions and the cards that we were dealt with. I did not see that a basic commodity would actually ramp up so quickly back to new 52-week high. So major surprise over there. You have an update on UPS as well, or should we go to our? Oh, okay.
Yeah, just a quick one, because we did get one question regarding whether there's more upside. Admittedly, when we made this call and the stock was around 95, I wasn't expecting this to rip that high. Like, I think my original target was 115, and Personally, I took profits around 120 right before earnings because I thought everything was priced in, and now I'm kicking myself. But in terms of whether or not there's more upside from here, I continue to see growth in e-commerce, and UPS has been increasing its prices almost on a monthly basis now. And at the same time, global trade is gradually recovering, and as corporate travel continues to stay weak, that's going to help demand for courier services. And also their healthcare segment is growing nicely as well. That said, it's hard for me to quantify how much of future earnings the market has already brought forward. But technically speaking, I think it is forming a sort of a bullish flag pattern. I guess that's all I have. What do you think, Fahad?
Well, I actually think that when stocks run up like this, I don't shoot against them just because they run up so much. It's the qualitative side of it because and usually they tend to they tend to continue to run, but although volume continues to fall off, or they go in long-term consolidation phase. My point here is that nothing that goes up on very high volume just makes a dramatic reverse and then and comes right back down. They were real buyers, they were powerful forces behind the breakout that we saw in UPS, and I think they're not going to give up on this one so easily. So I actually still think, given all the FedEx problems and the e-commerce trends that are very sticky in nature that will continue to last for several more months to come, definitely valuations have expanded, but I actually still don't think it's done going up. I think that if there is going to be a pause and a little bit of a pullback, you're talking within 5 to 10% of the current range. Nothing dramatic, collapse over here, but that's how stocks consolidate after a very strong run. If you can deal with that 5 to 10% potential consolidation range near 52-week high, I still think it continues to pay to continue to remain long this stock, because I think over time there's still going to be the upside. I have to say this is possibly one of your best calls in JaguarMedia. For those who do not know, on May 21st, this big bull case was presented with a video, 17-minute video recommending to get long UPS. This was right around here with the stock at $94.95, and here we are now at $160 per share, only 2.5 months or 3 months into it. So one of the best calls I've seen since then, since Chronicle. So I still think it goes higher, but be mindful that short-term consolidations are very common after high volume breakouts, and they usually are within a few percentage points range of the new 52-week high. Don't shoot something against something just because it has run up too much. All right, Avo.
Morning, everyone. Looking at Inspire Medical, INSP today. A couple of days ago, this, by the way, is a very nice chart considering what's going on currently with hospitals, limited operation especially for elective surgery. A couple of days ago, there was some buying or a buyer in September 115 calls, which kind of targets possible ANTM policy addition. Now, the ANTM is the really the only big commercial payer left without a policy, and it would add about 42.5 million lives to Inspire's current 190 million count. Now, this doesn't mean it's not a 1-for-1 translation. Doesn't mean that they get 42.5 million clients. It just means that there's a potential that out of that they'll get a lot of coverage. I wrote a short note that I'll put through shortly. I'm actually just trying to come up with a title, and that's kind of stumping me. But that's it. So there's this possibility of coverage extension coming sometime, maybe late September or early October.
That's when it's effective?
Pardon me?
That's when it's effective, the Anthem partnership, late September?
No, but the decision would come out.
I see.
Because
okay.
Anthem has typically, from what I understand, they have their meetings late August to early September to decide what they're going to add, what they're going to extend to the coverage. Furthermore, next year, looking further ahead, they're working on expanding into Japan and Australia. They recently got approval in Australia, so they're just working on reimbursement coverage negotiations. So I think that we might see also a better, or not a better, but an increasingly positive quarter coming up ahead. So I'll just push this note through shortly.
Sounds good. Looking forward to that note on the homepage. This has been our favorite. I know Avo has talked about this multiple times in the chat rooms and other places. We have covered this in multiple times. And look
And
at
it
this.
was a fourth quarter 2018 outlook.
Yeah,
One
it
of
was
our
a
topics.
former topic as well from more than a year and a half ago. Steady climber, and you know what? It amazes me how many people actually it doesn't ring up as much. You know, in terms of research, in terms of the coverage we see and discussions around this. But a steady climber, nonstop, just continues to mind its own business, and it has for the long-term buy and hold kind of crowd. This has rewarded them very, very nicely over the course of last 2 years, even coming out since the pandemic bottom in March. So. Nice update on Anthem, and I think that partnership could potentially be big. Depends on how quickly they get the acceleration in the adoption of those 45 some million members. Looking forward to your article on homepage soon. And nice steady chart, nothing wrong with it, just continues to go up, steady up, and continues to march higher. Okay, that's it from us, a little bit longer than normal. We'll see you in the chat room shortly. Thank you.